want to welcome everyone for the videos that we're going to cover deferred taxes. We're going to cover a little bit about deferred tax liabilities and deferred tax assets. Okay. The reason we have a deferral is because of timing differences between FASB's and IRS reporting. And it's a temporary difference. So eventually the idea is that they will eventually come together, but it's a temporary difference right now. So what we have here is to create those tax liabilities, deferred tax liabilities, things like the installment sales of property. Basically what it is things that are reported on the financial statements, but on the tax returns will be reported later. Okay, those will create tax liabilities, such as installment sales of property, unrealized gains from the investments that you may have that have to be reported at fair market value, and accelerated depreciation methods over the straight line, and prepaid expenses. Those may all create a deferred tax liability. A deferred tax asset maybe comes about because of rent collected in advance, and these are items that will be reported on the tax return now, but they'll be on the financial statements at a later time. Subscriptions collected in advance, the unrealized loss that you may have from those investments that you have, like trading in marketable securities. So those are some of the things that may create the deferred tax liabilities. So now what we're going to do is go through and set up how you record these differences and the journal entries that you may have. The first thing you want to do is find what the taxes payable are. Okay, so with that, we'll have the equal taxable income is $35,000. Of course, your tax rate is 25%, and then you take the $35,000 times the 25%, and that gives you $87.50. Okay, the pre-tax income was $50,000, and again, it's a 25% tax rate, and then you multiply these two out, 50,000 times 25%, and that gives you $12,500. And then the difference is our deferred tax liability in this case. Now I use ABS because that stands for absolute value, because that way it doesn't matter what order I subtract them in, and that gives me $37.50. Well, I just put that one down there. It's not really necessary. So the deferred tax liability I know is $37.50. Income tax payable is $87.50, and then we have to find, that's our change is what it is at $37.50, and then this one is the $37.50 plus the $87.50, which is the $12,500. And the reason why that's the change is because we didn't have any beginning balance. Now, for example 2, we have a building now that's $350,000 book value. The tax basis is $275,000 because remember, makers, IRS allows makers, which is an accelerated depreciation method. We have taxable income of $3,200,000 and 25% tax rate, and then $15,000 deferred taxes. That's my beginning. So I already have something in deferred tax liability of $15,000. Now, I use a double T account. I like the double T. This is my debit column. I'll highlight it. This is my credit column, and this is my balance column. And this is why I like using the double T, and I'll use it for everything. Okay, so now we look at the depreciation difference. Well, the depreciation difference is the 350 minus the 275, which is 75,000, 25% tax rate, which creates the deferred tax liability of 25%, $18,750. So that's what I need my ending balance to be. So you see it went up. So now we have equal 15,000 minus 18,750. So it went up 37.50. Okay. I really wouldn't even need this part right. I said I need a tax payable. Okay. So my taxable income was $3,200,000. That's 25%. And it's 3 million times 25%, which is 800,000. So now I know this income tax payable is 800,000. The deferred tax liability, I need to increase it by 3750 because that's my change. And then this one, the income tax, is those two added together. So 803,750. Okay. So hopefully that helps on that one. And that's where we need to increase it. Now this is one. On example 3 here, I don't have it on here, but the machine was totally deductible at the time of purchase. So that the book value is the difference in the depreciation. So that's the 500,000. Of course, your tax rate is 25%. Then we multiply these two together, times 25%, gives you 125. So over here, we started with 150. We now need 125 because eventually it's going to get to 0. That's the theory of it. So this is the difference between the two. And that's why I like this. I need to go to 125. I'm at 150. So I need to decrease it by 25,000, which you don't need that, but that's okay. So I know that is 25,000. Income tax payable is the 7,500,000 times 25%, or 1,875,000. And so this is the 1,875,000 minus the 25,000, or 1,850,000. Okay. So that's decreasing the tax liability. The other two were setting it up, and this one was actually increasing it. This one's decreasing it. All right. Fourth example. This is like the first one, except this time you notice the taxable income is greater than the accounting income. So we go through the same process. The 50,000, because what we're going to do on this one then is, of course, set up the tax. Whoops, I messed that up, didn't I? It's not 50,000. Taxable income is 68,000. 25, so we multiply those, 68,000 times 25%. Okay, the accounting income was 50,000, 25%, 50,000 times 25%, and then this is the difference between the two. Sale 12.5. 4,500, and that's not the DTL, that's a DTA now, which is deferred tax asset, and that's the 4,500. Okay, so deferred tax asset then will be the 4,500. Taxable income is the 17,000, and then this one is the 17,000 minus the 4,500. Or 12,500, which is what we have up there. Okay, and sometimes we don't know this one. That's why it says you have to find it. So you want to find the tax payable first, then the deferred tax liability or asset, and then the change in that asset. Well, since we didn't have any beginning change, we didn't have to worry about it. Now, I am going to quit there, and then I'll continue on with the valuation and the change of tax rates in the next video.